This video is looking at the end of the second AAT personal tax sample assessment. It's the tasks on capital gains tax and inheritance tax. So that's tasks 7 through to the end. So task 7. Identify whether the following statements are true or false. An uncle and niece would be treated as connected persons. No, because my golden rule is a connected person is a relative other than aunts, uncles and cousins. A disposal of an asset caused by the death of the taxpayer is a chargeable disposal for the purpose of capital gains tax. No, because it would be subject to inheritance tax. A gift of an asset to a friend would be a chargeable disposal. Yes, it would, but we know that we'd have to use the market value in our calculations. Mr. A made a number of disposals of capital assets during 21-22. The disposals have been made to unconnected persons. Calculate the amount chargeable to capital gains tax. So that's not the taxable gain, so it's before the deduction of any annual exempt amount. Into zero if applicable, whole pounds. So a car, I don't even have to read it, I know a car is exempt, so I put in 0. A painting. Sold a painting for 10,400. Bought it for 7,200, so it's all over 6,000. So I just need to do a normal calculation. So it's 10,400 minus 7,200 minus 2.5% of the 7,200 and ignore 400 spent on insurance because this is capital gains tax now. So it would only be capital enhancement which would be deducted. Don't get it confused with the property income on the income tax section, right? So 10,400 minus 7,200 minus 2.5% of the 7,200, which is 180, gives us an answer of 3,020. Table. So a table is a chattel, it moves. 6,720, 5,200, so we're straddling the 6,200. The sales proceeds are above, so this is the one where we have to check it against the 5/3 rule. So work it out as normal, 6,720 minus 5,200, that's 1,520. And then we compare that to 5/3 of the gross proceeds subtract 6,000. So that sum, that formula gives us 1,200. 1,200 is less, so we cap our gain at 1,200. Mr. A sold all his land for 170. And it's not actually a part disposal then, as it normally is with land. He bought 10 acres for 45,000, so we have to minus that. We minus the legal fees. We minus the 65,000 minus the 2,000 legal fees. But we ignore this 5,000 because it's to do with repairing, which is a revenue expense. Right, so that gives us 56,500 as the amount chargeable to capital gains tax. And then finally a ring that is bought and sold under 6,000. So chattel, it moves, so exempt. So task 8, the third human marked question on the paper for 8 marks, the share disposal, a grid given to you with 4 columns. Start by heading it up, date, details, number of shares and the cost in pounds. By writing cost in pound, you just discipline yourself to ignore all the red herrings that they may give you in a question. So have a quick look and see if there's any matching rules applying. So our tax year 21, so we're selling 400 shares here. So nothing bought on the same day, but something bought within the next 30 days, which is our number 2 match. So 200 there, which means that 200 shares are going to have to come out of the pool. So let's go with our pool. I always do this at the top personally, but it doesn't really matter, but it's just personal preference. You can just get straight on with the question then. Same every time, same headings. So we've got the 5th of May 13 purchase. We've got 1,000 shares, £36.20. So that's a total of 36,200. I guess you could show 36,000. I guess you could show the examiner that you know what you've multiplied there by, just in case. Next row down will be the 12th of August 2015. This is a sale, previous year sale. The £42 absolutely irrelevant, right? So here we are doing 300 and we work it out at an average. So times that by the 36,200, the previous cost, divide by 1,000. We know it's 36.20 anyway, don't we? But never mind. And that is giving us a cost of those sales of 10,860. Probably like to have these in. Can I? You can't. Oh yeah, you can. I'm going to put that in brackets, 300, so that I know I'm subtracting it. And then I do a running total every single time after every transaction, always show what the number of shares and their total cost is. Right, so that's the 12th of August 15. 2nd of November 15 is the next date. And on that date, we have a 1 for 20 rights issue at £35 per share. So 1 for 10 rights issue. So we're going to do 700. Let's do it here. 700 divided by 10. So we've got 70 shares at, how much was it? £35 each. So 70 shares being added on there. I read that. Yeah, it's 1 for 20. So you click on that, and then if you use the backspace, it gets rid of the last letter, but then you can use the arrow keys, it appears, to just amend it like that. So this should have been, so I'll do the same. So it won't let me go straight to the arrows. Backspace for 1, and then retype that, and then back arrow. So that should have been 20. So that was actually 35 shares at £35 each, which is 1225. Do another subtotal. So we had 700, we're adding on 35. We had 2534, we're adding on 1225. And then we are going to make our sale. So 25th of April. So we have got our sale. Now remember, we figured out that we've only got to do 200 here, and the calculation is going to be 26565 divide by 735, and then multiply that by the 200 shares, because that's working out the average cost of the shares disposed of. So that gives me 7,229. And then once again, I show clearly asks for this. Yeah, value to carry forward. You must do this bit to get full marks. So 735 take away 200 leaves us with 535. And then 26565 take away 7229 is a value of 19336. Leave a gap, and then we can work out our capital gain. So the proceeds were that we sold 400 shares at £50 each. So that is a total of 20,000. And then remember the matching rules. So the cost, if there was any same day, that would go in here. We've got next 30 days. So we had 200 being matched, £46 per share. So 200 times 46 is 9,200. And then the cost coming out of the share pool that we've worked out here. So 200 coming out. And by doing this, you can double check that you've definitely accounted for all the shares. I don't have to show, but obviously that comes to nil at the bottom. We worked out here that the cost of these shares is 7,229. So my gain is 20,000 subtract 9,200 subtract 7,229 is 3,571. Done. Task 9. Another capital gains tax question. Identify whether the following statements about capital gains tax are true or false. Allowable losses in the year are deducted from chargeable gains before the annual exempt amount is deducted. Yes, you have to offset the current year losses. That's talking about in the year. So, wait a minute. Allowable losses in the year are deductible from chargeable gains before the annual exempt amount is deducted. I want to say true, but one I prepared earlier, it says false. I'm just going to go on the answers and double check that right now. I did this last night at about 2 in the morning, so I could easily have made a mistake. So I don't want to tell you the wrong thing on the video. So just bear with me a second. So practice assessment, number 2, mark scheme, and I'm on task number 9. No, it is true. Lucky we checked. Thought it was true, but I'd written down false. So let's go back to where we were. So yeah, so true is the correct answer. An additional tax rate taxpayer will pay capital gains at 45%. No, they won't. It goes 10 and then it goes 20 and that's it. Married couples and civil partners can only count one property as their main home. Yes, it is combined. Seems a bit unfair, but there you go. And allowable losses brought forward can only be offset against chargeable gains in the tax year immediately following the losses. Any remaining losses are lost. No, that's not true, because allowable losses brought forward are subtracted against the taxable gain after, well, sorry, you've got your chargeable gain, you take away your annual exempt amount, then you take away any allowable losses brought forward, and then if there's still some left, you can carry them forward. It's the annual exempt amount that is lost. So that one is false. Right, then a question on PPR by the looks of it. Mr. Q sold a house for 440,000. He had bought the house 150 months ago. Oh, good, we haven't got a count. It was his main residence until he bought a flat 24 months before he sold the house. The flat became Mr. Q's main residence on the date of purchase. Right, so as we know, we're only allowed one main residence at a time. per person or per married couple. But the last 9 months are always exempt regardless of reason. So we just sort of split this 150 months. So 24 months is not resident or deemed resident, but actually the last 9 months are. So if we do 24 take away 9, that gives us 15 months which are not main resident or deemed resident. So that means that there are 135 months out of the 150 when he is either resident or deemed resident. So what's the question? Enter your answer in whole pounds. The total amount that Mr. Q will pay capital gains tax on after all allowances is, right, so he sold it for 440 minus 260. So his gain is 180,000. We then take off his principal private residence relief. So that is calculated as the 135 months divided by the 150 when he's resident or deemed resident, times the gain, the 180,000. So he's got PPR, principal private residence relief, of 162,000. Right, so that means that he's only got to pay 18,000. Now we could have got straight to that just by saying, well, it was 15 months out of 150. So 15 divide 150 times that by the 180,000 would have taken us straight to £18,000. But it's after all allowances. So don't forget about the annual exempt amount. So 18,000 that we're up to so far. Take away the 12,300 means he will pay tax on £5,700. Dr. K, how many marks was that? 2, fair enough. Dr. K had the following capital gains and losses in the last few years. We've got to work out the amount chargeable, if any, to capital gains tax for 21-22, and if there are any losses to carry forward to the next tax year. Right, so starting in the year 1920, gains take away losses. So let's just do this. We've got 14,320 minus 8,450 is 5,870. So I'll use what I can of my annual exempt amount, bring it down to nil, lose the rest of my annual exempt amount, and there's no losses to carry forward. So that's the end of it. 2021, I do 25860 subtract 34220 is a loss of 8360. So that loss can be carried forward. So the figure is 8360. Hold that thought. In the year 21-22, we have a gain of 18,740 minus 4090, which is 14,650. We have to subtract the annual exempt amount first because we don't want to lose that. So that leaves me with 2,350 of gain. I'm going to use 2,350 of my loss that was brought forward from the previous year to bring my capital gains tax, the amount chargeable, down to 0. The losses carried forward will be the 8,360 that we had from the year 2021 minus the 2,350 that we used. So that means that we've got 6,010 remaining. Mazel made net capital gains of 20,140 in 21-22. Mazel's taxable income after personal allowances was 41,320. So she's a higher rate taxpayer. So the total amount that she will pay So she's got net capital gains of 20,140. Remember, capital gains interchangeable with chargeable gains. That's different from the taxable gain. We haven't taken away the annual exempt amount yet. So we need to do that. So that brings me down to 7,840. She's a higher rate taxpayer, so she will be taxed on that amount at 20%, which gives us an answer of 1,568. Final question, inheritance tax, 10 marks. Identify whether the following statements are true or false. Transfers of assets between spouses or civil partners are potentially taxable. No, they're exempt. A gift of 2,000 from an uncle to his niece on the occasion of her marriage would always be exempt. I'm pretty sure that's too much, but let's just quickly check. Inheritance tax exemptions, marriage, who is it? An uncle. So that would be an other. So it's only £1,000 that's allowed. So that's false. It's not going to be exempt. Limited companies are not treated as chargeable persons for inheritance tax. Correct. It's individuals. Every year, Mrs. H gives 200 to each of her grandchildren for their birthdays. These gifts would be treated as exempt transfers. Yes, it's £250 small gift exemption per recipient per year. So that's fine. Inheritance tax payable is calculated depending on the income tax rate of the deceased. No, it's 40%. Complete the following statements. A potentially exempt transfer is only chargeable to inheritance tax if the transferor, that's the person that dies, within the magic number 7 years. Where a person does not use all their annual exemption in a tax year, so that's the £3,000 on the lifetime transfers only. So we know that we can use it just for the next year only. Complete the table below to show whether these gifts will be exempt or potentially exempt. These are the only 3 gifts made during her life. So a national political party, that's exempt. Gift to daughter on her wedding, so we've seen that that's too much. Even for the daughter, it's 2,500, wasn't it? No, parent 5,000, sorry. But still too much. So potentially exempt on the 15,000. Painting to a local museum is exempt. So political parties, charities, local museums, art galleries, that sort of thing, exempt. And that concludes the second AAT sample assessment. Let's just double check that we definitely got them all right. Obviously it doesn't mark the human marked ones, but let's just check the marks on all of the others. Yes, good. So, hope you found it useful.